Hey there, everyone. Happy Sunday. Let's talk about what we got coming up for June trading or investing in the stock market with what exactly we could see happening in the charts based on the economic reports that we have coming out, because June is shaping up to be absolutely massive. In my opinion, it is the deciding month. Matter of fact, these next few weeks are the deciding weeks that we have for whether we see new all-time highs or whether we go back down to that 200-day, possibly even below. So I want to give some of that context in this video and talk about what we should be looking for. And if you guys enjoyed this analysis, you want to see more of my analyses, you can check out the link down in the description for the Discord. You get to see not only my market analyses, but my technical analyses and my buys, sells that I have for the trades that I do along with me and the other panel experts. Links in the description for the Discord. We'll talk more about it later. In the meantime, let's pop this up here for you, because this is Trading Economics for the month of June, and we kick things off with ISM Manufacturing. As long as we don't get anything strongly, surprisingly negative, that's going to be all right for us. Slow, steady climb is what we've currently been doing, but we've been with contractionary numbers recently for a while now. Moving on, the big thing I think is JOLTs, which is the first thing that we should be paying attention to on here. And JOLTs, 10 a.m. on Thursday, June 3rd. We want to be looking for that. What are we looking for exactly for that? In my opinion, staying north in the sevens, the 7 million job openings, keeps us up above what we had in September of 7.1 million openings, because these are in thousands of thousands as we look at these numbers that are on the screen in front of you. We absolutely want to stay above that. If I take this and go out 10 years and you can take a look and see the bigger trend that we have happening, you can see that we've been on a decline for a while now. Now, mind you, that's coming off of the pandemic. So we returned to trend. Now we started dropping down below trend. And then the previous low that we had, lower than what's right now, actually goes back to, there we go. There's the 7.1 million in September. We're just barely above that, close to 7.2 million. And then we have to go back beyond that into just the months that were during that pandemic time. But if we go back prior to pandemic, we really start to see those numbers, I would say in the high, we'll say above 6.5 million, if you will. When we start to dip below those, I think that the market is going to start to get really spooked on that. Now, mind you, staying above that is going to be a very strong thing for the market. So if we stay above 7.2 million, the forecast from Trading Economics right now, 7 million, 7.05, that's still a decline, an expected one, so it could be priced in right now. But if we come in more strongly on those JOLTS numbers on Tuesday, that's going to be very encouraging for us. Now, mind you, we do have a proxy for sentiment. I'll give that for you as well, something that I like to use to watch and see what's being signaling in terms of economic strength or weakness through the bond market. We'll talk about that in a little bit. For right now, though, JOLTs staying up in the low sevens or even creeping up to the mid to high sevens, going to be perfect. The market's going to love it. Dropping down into the sixes, especially if we drop, the closer we get down to those mid sixes or below, things start to get pretty scary there. So we absolutely want to see that continued strength in the labor market. ISM services, once again, no scary low numbers. This one is already sort of a volatile measure for us. And honestly, I don't think it's one of the biggest catalysts. We do want to see this coming above 50. Coming above 50, we're golden no matter what it is. Coming down strongly below 50 puts us down in contractionary numbers for ISM services PMI. That would not be received so well. You can see we've been up here above 50 for a long time, besides really this big old spike down, this jaunt down that we had during the pandemic. So let's back up through there and let's look at what would be the next day and what's absolutely huge for that. Initial jobless claims and the continuing claims has been creeping up for a while now. So now this creep that you see, look across the peaks of this thing. Yeah, you see some volatility in it, but we're starting to really show a rising trend here. Especially if we look over the last 3 years, you can see that we're really starting to get the peaks on those continuing claims going on. That average for us is starting to creep up, and that's making people a little bit nervous. So the Fed says that we see this weakness coming out in the soft data, but we don't necessarily see it in the hard data. Well, right now, unemployment, we'll get to that in a moment, still sitting at 4.2%. The layoffs are a place that we're looking at for those jobless claims where people are going out and filing for that unemployment. And we'll see for those jobless claims that come out, will they continue to rise? That's going to be an important number for us, because when they start to hit a 2 point something instead of 1 point something, that the market, once again, I think there's going to be a sentiment around that it's not going to like that very much. And once again, brings me back to that number that I think works as a good proxy for what sort of risk environment we find ourselves in and what sort of economic strength we're looking at. So let's go back again. And then the next day we have non-farm payrolls and unemployment rate. Now, mind you, this is Friday, June the 6th that we're looking at right now for non-farm and for unemployment. Thursday, before that, we have a huge thing there, and we'll talk about that in a little bit, and that's the Trump tariff situation with the appeal that's taking place. Are the tariffs going to be something that get thrown out the window, or are they going to be something that stick around for a while? The appeal's been put in place, and that update comes out June 5th and June 9th. So we actually have, starting on Thursday of this coming week, that's going to be huge, and it could hang over our heads until the 9th. So it really does depend. And so I'll bring some of that nuance together for you. But non-farm payrolls, what are we looking at here? Well, let's check the trend that we've seen so far. And you can actually see that we actually hit that low for non-farm payrolls in October 2024, and then getting a couple of spikes in there through November and December, and then pretty much settling from that point forward. Now, if we look at the 3-year trend, let's try 5-year trend. There we go. We start to get the pandemic in there. Doesn't do us too well, but what you can see is that we have a drop in non-farm payrolls, and then looks like it's starting to rise again. So what are we looking for? Well, if we stay in 3-digit numbers, we're probably still pretty much in good shape. Right now, consensus is 130,000. If that starts to drop back down to 2 digits, the market's probably going to hate it. The stronger that number comes in above consensus, above the 130,000, the better it is. The lower that comes in, the worse it is. So we absolutely want to see that. The big thing that's being watched right now is unemployment rate, because if you look and see what we've seen now, looks like 5 times: July, August, November, March, April, 4.2%. It seems like every time we get there, we pull back again and we start to get numbers that are between 4 and 4.2%. 4.3, the market might jump a little bit at that. If it goes right to 4.4, that's probably going to give the market a little bit more of a worry, and you're going to start hearing people come out and start talking about the SOM rule again, is my guess, where they start talking about, hey, we could see this early sign of recession. The SOM rule's never been wrong. We'll see if it ends up being right this time as well. So just be on the lookout for that. Going from 4.2 or below, we're absolutely golden. The market's absolutely going to love it. 4.3 maybe sort of okay, depending on the other information that we get that goes along with it as well, including the Trump tariff news starting on June 5th and then ending on well, not necessarily ending, but continuing on June 9th, where we actually get more information on that. So those dates are highly impactful for us, but we absolutely, 4.3 is going to be very arguable how the market receives it. 4.4 and above, the market's really going to start to panic. I've saw 4.5% as being one of those other forecast numbers out there. 4.5, market probably take that even worse to make that 0.3% jump all of a sudden in unemployment. So getting whipped around, more whiplash than the tariff news by the unemployment numbers would be absolutely worse. So jumping up above that high end estimate of 4.5% for June, now we're really starting to get into significant downward pressure territory. Now we're probably going to drop down well below the 200-day moving average, because now the market really starts to get spooked about recession, and putting in really hard evidence about that is really going to ruin the sort of rally that we're on right now. If we don't have that hard evidence, if instead we continue on the path that we're on, the market's probably going to stay above the 200-day. We'll take our lumps along the way. We really need to push up above some significant technical levels that, once again, I'll share with you when we get to the charts. So let me put this back up here. So for unemployment, we do want to watch the other numbers that are out there and see the story that they're telling all together. But unemployment is going to be one of those critical capstone numbers for this week coming up. That 4.2, if that's what we come in for consensus or below, golden. Absolutely incredible. Now, mind you, we still have to bring the other context that we get through JOLTs and through non-farm payrolls and in continuing jobless claims. But I really think this is the capstone that we're looking at for unemployment, that it kind of lets the market breathe a little bit easier if we get 4.2 or below. 4.3, the market's kind of probably pause a little bit on it, not really like it too much, but probably not hate it too much either. 4.4 and above, when we start to make those bigger jumps, that's where the market really starts to get upset about that. So we'll see what sort of flavor we get from companies for, we'll say, the tariff impact that we have, or maybe it's just the inflationary impact that we start to get more evidence of the pricing power of companies starting to peter out, for example. So that's what we have for this coming week. And then when we start to get into the next week, June 11th, we start to get into CPI. June 12th, we get into PPI. And so we'll see what we get for those. Inflation, I think, is probably still going to come out to show that we have subdued numbers for that. And really the tariff situation And well, there's Michigan consumer sentiment on the 13th of June. Watch what the market does through these early trading days in June. That's probably going to impact what we see here. Probably not going to be so bad. We'll see what gets rocked right there. So the big thing that we have coming out in June 18th, though, is not the housing stuff, although that is pretty big as well. But we have the federal interest rate decision and the FOMC economic projections. This is the summary of economic projections. And this is probably, we have a lot of black curtain, black veil, whatever you want to call it, events coming up for us, maybe even event horizons, if you want to talk about that. The black curtain that we have is the things that we just can't see past right now, so we don't exactly know what to plan on. But when the Fed puts out that summary of economic projections, do they see those higher inflation numbers? And they just might, especially depending on what we see with the tariff situation. And we want more commentary on what the Fed is seeing with that. So this SEP that we get along with it, the summary of economic projections for June, it's our update since March. March was pre-Liberation Day. This is our first SEP post-Liberation Day. For a term coined by Trump for April 2nd tariff situation that we have that announcement for. So what will the Fed say for that? Do they see that higher inflation? Do they see higher unemployment going along with it? What do they see the impact on GDP being? And I think, we have a lot depending on what the Fed has to say. Makes June 5th and June 9th just so darn critical to find out what's going on with the tariff situation. Is the appeal going to be upheld and that the tariffs stick around for a while longer? And then we're looking at July 9th and then later in August. I think it's August 14th for China. I'll have to look at that. Or is it going to be the one where the court says, you know what? Nope, tariffs are back out again and the markets are absolutely going to love it and taking a lot of the pressure off the Fed. Now, mind you, I don't know that there's any near-term end to the tariff drama, whether or not the court upholds the decision on the tariffs to say, nope, tariffs are out, the Trump tariffs, Liberation Day tariffs are out, or if the appeal holds. Either way, I think that there's going to be just a lot still going on with the markets based on the different things that Trump comes out and says and does. It's just going to keep on being those narrative shifts that we have in the near term that keep on messing that up. Now, on a trading basis, that can be pretty wild. On an investment basis, well, then that's a long-term thing depending on what your horizons are. For me, I'm still fairly young at 42 years of age. I still have, we'll say, half at least my working life in front of me yet. So I'm not really too worried about the short-term hiccups that happen along the way. This is just more volatility. I do look for those opportunities that come along, like the last time that we pulled back to what, if you look at the 23.6 that I put out, that will tell you a little bit more. So guys, link is down in the description for the Discord if you want to see more of my analyses, my trades, my technical analyses over there. Use code word doctor when you sign up. It's going to get you 50% off your first month when you sign up for their earner tier. Check it out. See what you think. I'm only one of the panel experts over there. There's a whole team of us that support you in this process through your journey towards financial freedom and trying to build alpha in your portfolio as well. And like I said, links in the description. Check it out. And if you want to do some coursework for options, technical analysis trading, there's some courses down there too through Stockmo Academy. He's a personal friend of mine. How I got into the Discord in the first place. When you click on that, you'll also see the name Stockmo there as well. We've been best friends for, oh gosh, let me see. Let's say probably the past 15 out of the 17 years that we've known each other. And I'll tell you what, he really is like a brother to me. I appreciate all that he's done. But those courses that he set up isn't just for me. Those courses that he set up are for you. He, Mrs. Mo, have put those courses together and they are top notch. Use the code word doctor when you sign up for those. That's also going to save you a ton of cash. Let's get into the charts, guys. I'm going to do some of the technical analysis for you to talk about where exactly we could go based on these catalysts that we have coming up. So let's go to the S&P 500 ETF here, SPY, and the number to beat here is 596. It's right up here, and you can see with this candle that we have down here, this is the 50% tariff on the EU, and then it was like, nah, never mind, we don't have that 50% tariff on EU. The market loved it, and then we had the whole appeal thing happen to us as well, that tariffs are gone, tariffs are back, and our heads just kind of got whipped around on this whole thing. And like I said, it's probably going to keep messing with us. So if we have unemployment steady, if we have non-farm payrolls also steady or up, and if we have the JOLTs report also coming out to be very strong for us as well, I think we're going to take on all-time highs. We got to break that 611 number that's up here. As a matter of fact, I think I have up here on here for you. 611.39 is that number to beat. To get up over this line, I think that can break us up over this resistance that happens to start right at around 594 and it ends right at about 596. So sitting on top of 596 is what we're looking for. So from a chart perspective, if we're sitting on top of 596, we got to close above it. We get a candle on top of it. Guys, we are set up to continue running on that. News dependent, economic report dependent, tariff news dependent, of course. But sitting on top of 596 is what we're looking for. If we can't, we're looking down to the 20-day at about 589. And also down below that is the 200-day at about 574. That's really what I'm looking for. Should we pull back in this market to get all the way back to that 200-day, which also coincides with other support that's there as well, I think that can set up that next major opportunity. That'd be that next place I would absolutely love to go long on different things in the market, including the market itself as per the S&P 500 index. So sitting on top of 596 or sitting on top of about 574. If we look at the Qs, QQQ, the NASDAQ 100 here, this one, the number to sit on top of is not the same as SPY. Obviously, this one is instead sitting on top of 524 seems to be where we're getting that resistance. And you can see we were not able to sit on top of that last time. We popped up above it and then closed significantly lower. But when we came down to this 513, we really pushed back on top of that. The market wants to go higher. It does. Let me say that again. The market wants reasons to go higher. The bulls are chomping at the bit to say, just let me run, just let me run. It really does depend on what we see. This is a huge week for us. Like I said, the labor reports are the big thing, but then also on June the 5th, on that Thursday, along with jobless claims, initial jobless claims, continuous jobless claims, is when we also get more news on the situation with the Trump tariffs. And then June 9th, we get more information on that as well. And that's that Monday that follows the weekend. Those are going to be absolutely huge for us. The market is setting itself up for the either eventuality that we're getting near that resistance. You can see it didn't want to go lower, it wants to go higher. It's getting near that resistance. This is critical resistance here for the Qs. If we get bad news, it's quickly going to drop. If we get good news, we're probably going to sit pretty easily on top of 524, and then we're trying to go back towards those all-time highs. The all-time high number that we have on the Qs here, by the way, happens to be, let me stretch that out for you. I'm using a different mouse at the moment because my other one died, and this one's highly sensitive to the movements that I make, and I'm not very coordinated. All-time high on here for the Qs is 540.01. That's this heavy dotted line that you see going across your chart right here. And also Bitcoin is, not that it's necessarily one of the stock indices, and I know I'm talking about the stock market, but I think this is also a good indicator for risk as well, that you can kind of see we're almost getting a bear flag look. We could be heading down towards this 98,451 number as well. But again, this week really depends. And this line that you see going across your screen right here, this diagonal line, is one of the important rays, one of the key rays that we have, that if we lose that, we do sell down to probably at least 98,000. If instead we get on top of that because the labor market reports are rocking and awesome and we potentially we get good tariff news on top of that, Bitcoin's ready to go back and retest this resistance that happens to be about 106 to 107,000. And then maybe that allows us to go back and retest this 0.618. As right now, we're testing the 0.5 number that we have here on the Fibonacci extension for 104,324 that I said was a critical number to keep. We'll see if we do, in fact, keep it. So one final thing here, guys, before I close it up, I said about having a proxy for what sort of risk environment we find ourselves in or looking at sentiment. So let me put this back up here for you, and then we'll wrap up the video. You'll enjoy the rest of your weekend, and then I'll be back on Monday. So the thing that I like to look at is the CME Fed Watch tool, and what I like to look at on here specifically, I like to look at the next month that we have coming up, and then I also like to look to the end of the year, looking out to December, and I watch as the news comes out. How are these percentages down here shifting for us? Are they shifting more towards cutting? If they are, then what that means is easier monetary policy, but that also means likely that we have some sort of economic weakness that we're looking at coming up, and that can be a mixed bag depending on the sort of time horizon that we're looking at and what exactly it can do to the markets. So for right now, what I'm looking at is what happens with the CME Fed Watch tool. What is the bond market saying about those rate cuts potentially coming our way, hopefully sooner than later? Is the Fed going to be caught on their back foot or not? So what we can see is that if the numbers stay about the same, or if they even strengthen towards no cuts, that can actually be a sign of strength, which is a little bit weird to think of. Economic strength, so that could be strength for those markets. We're going to have to watch and see, because that'd be less of a reason for the Fed to have to move sooner on such things. They would still say, we see it in the soft data, we're not seeing it in the hard data. And now, mind you, I think that overall that would be a bullish thing for the markets. Now, mind you, too much of a shift too quickly to the downside, too much of a rate cut sentiment too quickly could be, oh my gosh, what sort of weakness is there? Will the Fed actually cut in time? Are they caught in the back foot? That could be necessarily a short-term bearish thing for the markets, or at least some downward pressure for the markets. So those are the things that I look at for the CME Fed Watch tool, and how sort of I interpret it based on the economic reports that I see. I watch because they do adjust pretty darn quickly. I look at the near term and I look at a longer term end of things, according to the CME Fed Watch tool. So guys, like I said, down in the description, if you want to see more of my analyses, my technicals, my buys, my sells, along with the other panel experts that are over there, links in the description. Make sure you use the earner tier. Make sure you use code word doctor to save 50% off your first month. So when you try it out, you see the value that's there for you, and I think you're going to find yourself sticking around for quite a while. Also, that coursework down in the description through Stockmo Academy. Click on the link, sign up for either course, or when you bundle the courses, you save a ton. You save a ton more no matter what you do with those courses when you sign up using the code word doctor. Guys, thanks for watching. I am Dr. Stock, Doctor of Education. Remember, my friends, that learning is earning. We'll see you next video.